Hey, what's going on, y'all? So, in this section today, I just want to talk about something about the logic behind the market in terms of time frames, because I think a lot of people are getting these time frame things, concepts confused, right? I want to talk about basically the nature of the fractal movement of the market today and how we can use this understanding to help us better create context when we're trading. So, one thing first off is every single time frame is doing something different, but they're all lagging behind each other in an example. So I can create an example real quick, but one thing you want to take note is that the market is fractal, meaning anything that happens, for example, what I teach you guys in terms of structure on the 1 minute, we apply the same concept on the 5 minute. It just takes a different amount of time and candles to create that same structure, right? So market is fractal, number one. And number two is that using different time frames will alter your win rate and risk reward. Okay. So for example, let's say you want to an entry off an impulse model. Let's say there's a POI here on the left. Let's say there's a 15-minute POI, right? And you want to enter off an impulse model. So let's say you enter off the impulse model, which is a candle break. We have a buy stop, or you can market execute. I typically like a buy stop because it's a lot more accurate, faster. Sometimes if you market execute, you could get slipped, or just maybe if you're marketing a bit late, you could like potentially get a bad fill, right? So I have a buy stop typically for impulse model entries. Let's say just as an example, we use impulse candle break entry. Okay, if these were 1 minute candles, you would typically have a lower win rate than if these were 5 minute candles. What I mean is basically if you're waiting for a 5 minute candle break, you will have a higher win rate trading than a 1 minute candle break because we know the higher time frame holds more weight, meaning it gives you a higher win rate essentially, right? It matters more. It's more significant. Vice versa for like seconds. So like if I was in the 5 second time frame, for example, a 5 second candle break isn't significant really at all to me compared to maybe a 1 minute candle break, which is a lot more significant because a lot more time has gone by since the break of the candle, giving price time to develop internal market fractal structure on the lower time frame, right? A 5 second candle break to me, I never ever use because that just doesn't mean anything to me. It's too low in terms of significance, right? So this is why it's extremely important to make sure you have a set time frames for your trading plan, and you always stick to those time frames. That way your data is very consistent because we don't want to sometimes take trades off the 1 minute candle break and other times use a 5 second candle break. Your data is going to get corrupted and it just doesn't make any sense to me, right? The only times you would be if you use discretion and experience based on how price is delivering. But even then, typically based on how price is delivering, I'll be using a different entry model here rather than using a different time frame, if that makes sense. Like for example, I could be using an inverse fair value gap model, entry model, but it would still be on the 1 minute time frame rather than, for example, switching to the 5 minute, right? Things like that. And typically, the lower the time frame, the lower the win rate, but also the higher the risk reward. So if you enter off a 5 second candle break and you were right, then you will have a very tiny stop loss, right? And your risk to reward will be very high. However, the win rate is so low, I don't recommend ever for you guys to enter off candle break off the seconds, right? If you're on the seconds time frame, confirming off like a I don't know, 5 minute POI, for example, you would want to see structure breaks, for example, that I teach you guys. So for example, if you have a lower high, lower low, lower high, low, low, and then we break out this previous high that made that low. So we break that strong low. Now it's a weak high now. And then we essentially you would enter off a retracement here to an OB or for value gap after this, right? This is what I would want to see if I was entering off the seconds time frame. Other than that, I don't use impulse model off the seconds time frame, okay? I would mainly stick to the 1 minute or higher for that. And mainly the 1 minute for me because that's what I found best for a combination of win rate and risk reward. That's why I recommend you guys find what works best for you. For me, I just found 1 minute to have the best combination in terms of performance, in terms of the risk reward and win rate balance, right? Because again, I showed you guys a previous website that had the calculator between balancing your average risk reward and your average win rate, and it essentially shows your expected value typically of your trading system, right? So if you guys go back to that trading drill website, a product factor that I have in the Discord as well, you will be able to see what combinations work best, and you typically want to create or put the system that has the highest expectancy value. That means you can have a lot more room for error, right? So for example, let's say you had an 80% win rate at 1-to-1 risk reward. You have room to make mistakes, human emotional mistakes or technical mistakes, right? For example, all you need is 50% win rate at 1-to-1 for commissions and spread to break even, right? So you have a 30% wiggle room to make mistakes essentially. And even if you made those mistakes within that 30% win rate wiggle room, you will be at break even at worst, right? That's why having such a great training system in terms of performance stats is very crucial, especially the win rate, in my opinion. Okay, so now that we understand that using different time frames will alter your win rate and risk reward, we want to have a set time frames that we use. So for me, I mentioned this already. I use a 1 minute as my entries, 5 minute and 15 minute for my structure, and then 30 minute, 1 hour, and 4 hour. Typically, I cycle through for my high time frame POIs. In terms of these might cause if they're valid POIs, it might cause a reversal, high time frame reversal model. Or these POIs will also, or this is not these POIs, these time frames will be used as my external trend and can also be used as structure. But typically, I like to focus more on the 5 minute, 15 minute working on structure because it's a lot more easier to see the swing highs and lows than a 30 minute because we're trading entries off the 1 minute. So this is why it's like crucial to backtest this and make sure you understand which exact time frames to typically use because these time frames will typically not change, right? As in, like, if you have a combination maybe from past 2 years of using 1 minute, 5 minute, for entries and then structure, after, like, 5 years, the tip time frames will work basically the same way. You'll still be using a 5 minute for structure and 1 minute for entries. These don't change because this is time and price based, right? So, for example, what I mean by is this is, let's say 30 minute is like, for example, like, looking like this, you can't really mark out swing structure since we're on the 1 minute, you can't really mark out swing structure of the 1 minute off two candles that look like this on the 3rd minute. This is why I like to go on the 5 minute and 15 minute because then on the 5 minute, you would have, let's see if I can call this in. Pretend these are 30-minute candles or 1 hour, 4 hour, whatever. For daily, I just use that for daily bias. Other than that, I don't use it too much. You can use daily as well as for time theory that I teach you guys in terms of timing the market. Remember, open, high, low, close, open, low, high, close. You want to typically buying below the open of the candle, and then you're selling above the candle, depending on what your bias is. If your bias is bullish for a day, you definitely want to be focusing on buying below the candle, and instead of doing counter trend, buying selling above the candle open. So that's another thing you guys want to keep in mind. But essentially, for example, here on the 5 minute, you could say we would have like structure like this. It's not going to be as big as this, but we would have like actual structure here that we could then mark out essentially and use. Okay. So this is why it's extremely important for me to see the specifics of the market and how it's delivering. This way we can also pinpoint where inducement is. For example, maybe there's inducement here. There's maybe microstructure here, right? So that's why I like to use the 5 minute, 15 minute, what I found best as my structure to mark out my external structure. And then 30 minute, 1 hour, 4 hour daily is typically just used for direction or POIs. On the daily, you will notice you won't really have fair value gaps or imbalances typically often on daily just because of, again, how time and price works. The higher the time frame, the less like frequency of setups you will see. So typically the daily is very balanced. The market loves to be balanced, right? The market is always looking to balance out inefficiencies and everything. In a daily time frame, the higher time frame you go, you will see there's a lot less inefficiencies because the market has typically essentially facilitated all the orders at every single price level. That's why it looks very balanced on a daily. So usually on the 1 minute, for example, we would have a lot more imbalances in OBs and PYs than a 5 minute or 15 minute, and then vice versa if you go even higher. So that's something you guys definitely should have noticed if you haven't. That's definitely something to keep in mind. So yeah, there's that. And now I just want to go over and talk about essentially after understanding which time frames you guys want to use together in combination, you then want to understand the fractal nature of the market, which is this. So this concept is, let's say we have a 4-hour POI here. Let's say we have a 4-hour supply on the left. Okay, we had a 4-hour supply, and then now let's say price is coming back up on a lower time frame to come back up to a 4-hour supply. But what happens to the market in terms of structure, at least, or even entry models, is essentially the first sign of weakness or change in the market state of delivery or change in the market direction is going to be on the 1 second, okay, or even ticks. So on the 1 second, we could have something that looks like this, right? And then reversal. And then when the 1 second is developing structure like this, later on this bleeds into the 5 second structure. Then the 5 second structure starts creating its own internal change of character like this, right? And then this leads to then a, for example, we could say 15 seconds, then 30 seconds, then 1 minute change in character now, or change in delivery in terms of structure, right? So you go from, for example, we can go from 5 seconds. I don't ever look at the 1 second, so we can go from 5 seconds, let's say, to the 1 minute, and then to the 5 minutes. So typically, this is how the fractal nature of the market works. So 5 seconds will give you a sign of weakness in structure, telling you know that the market may potentially reverse way before the 1 minute. So 5 second structure is then creating the 1 minute structure, which is then creating later on the 5 minute structure. Now all this has a lot of time difference in between. For example, the 1 minute is uh 12 times the length in terms of duration of the 5 seconds, right? 5 seconds is 12 times faster, and a 5 minute is 5 times slower than a 1 minute in terms of delivering structure, right? In terms of time. Remember, time and price is extremely important. So this is something that we definitely need to keep in the back of our minds and understand that price is always going from a lower time frame to then developing a higher time frame structure. So for example, if we want to see this fractally, here I can zoom in here real quick. Hopefully this works. Okay. Yeah, so basically on the 1 minute, for the 5 seconds, could be, let's see if we can find a good example here. Uh, this could be the 5 seconds right here. It's not a good, you can't really see that, but pretend it's making high highs, high lows, and then it does a change of character. This right here on the 5 seconds could be just this leg here on the 1 minute, right? That's a correlation between the 5 seconds and the 1 minute, for example. Or it could also be this leg here on the 1 minute, or it could be this leg, or it could be this leg on a 1 minute. We don't know exactly, and that is why the higher time frame in terms of POI, the bigger the POI is, the less refined it is, the higher the time frame you want to use for your entries. So, for example, if we had a 4-hour POI, I would never. First off, I would never really use a 5 seconds structure change of character, just because I find the 1 minute tells me enough about the 5 seconds. I can see what the 5 seconds is typically doing while staying on the 1 minute. This takes more experience to get used to and understand, because you need to understand how candles close, right? And open, high, low, close. The concept that I teach you guys, that will tell you essentially roughly how the story of the 5 second looks like. So for example, here we have a sell to buy, right? That means in terms of candles, price is doing this, right? And closing above on the seconds. This is these two candles is the same thing as this movement on the seconds. Okay. That's just a rough example for you guys. So that is why for the bigger POI, you typically the higher time frame, they will have bigger POIs. That's why I tell you guys always to refine your POIs. So when you have a 4-hour POI, try to find a 15-minute, 5-minute POI. That'll be very suitable. For example, we found a 15-minute POI maybe, and then within this 15-minute, maybe we found 5-minute POI. And then we want to find, of course, we typically want to look for a flip, causing internal breaks of structure, or we want to be looking for the origins, right? The original extreme zone that caused this whole entire change in the market in terms of external swing structure. And then once we refine those, then we could potentially look for seconds entries. But again, there's no need to pay for seconds. You guys can just safely, easily use it 1 minute entry models I teach you guys and just take advantage of that instead of the seconds. I don't use the seconds as much anymore myself. But it's definitely good for experience as well. So it all depends on what you want to do. I would say don't overcomplicate trading and just stick to the 1 minute. Stick to one time frame for your entries typically. And the only time I would switch off the 1 minute for entries is if something's not clear. If the 1 minute is not clear at all, not creating any imbalances when it's moving, very choppy, then I'll try going to seconds and see what's going on, right? But other than that, stick to the 1 minute. I highly recommend that. And this is why you don't want to use 5 seconds for a big PY because in a big PY, there could be tons of price action movement. For example, this is a 1 minute. It could create tons of structure like this and also false reversals. So that's why I highly recommend the bigger the time frame, the bigger POI, and typically higher the time frame you want to be using for your entries. Let's say we had a 1 minute POI. That is then when you could safely use a 5 seconds change in character or change in delivery in terms of price structure, right? Because the POI is very small, meaning there's not many 5-second candles within this POI. But in a huge POI, there's so many 5 second candles, meaning there's so much 5 second structure that it's just not reliable. So this is something, if you don't understand fully what I'm trying to say, you will experience this in the real live market when you do this either through back testing or things like that. You will understand what I'm trying to say here in terms of how using certain time frames and using the proper time frames in terms of proportion to the POI time frame is extremely important. And just understanding that not every time frame will deliver the same win rate and stuff, but it will deliver the same type of structure in terms of price, right? In terms of how price delivers based on the algorithm, it will deliver the same way on these smaller, lower time frames. So this is again just basically what I just wanted to go over today. Same thing works for bullish, bearish. You guys should know it's all the same for both these time frames. So, and this is basically it. So that's why I would like to see, for example, let's say you enter a 1 minute change in character, price comes back, limit order, and then you confirmation, you enter. If we see the 5 minute shifting structure after we enter on the 1 minute, that is just more confluence to us that we are in the right direction, right? And then let's say the 5 minute later turns into a 15-minute structure that shifts. Then that's even more confluence that price is likely to head even lower. But of course, for us, since we're entering on the 1 minute, um, we're not holding for these insanely big moves, right? We're just looking to get in and out of the market very fast within the day. I'm not looking to hold trades for uh, a very long period of time, but you definitely can if you want. Personally, for me, just based on my trading style, I don't like doing that. It's like, so for example, sometimes there could be times where essentially some of the trades you take may run like 100 hour later, maybe in 2 days, right? Because we are entering off the seconds or we're entering off the 1 minute. But that's definitely not something we want to be holding for, right? Especially if you're trading on like Apex with live trading and drawdown, you would instantly get your account blown since you're risking high risk reward. So for example, to hide an example here, let's say on the left there's some major liquidity or external liquidity we target. Price could typically you can typically expand this CP if we really caught the low of this pullback here on the lower time frame. We could typically just throw our stop loss or continue targeting something crazy on the higher time frame like this. You get a 56-hour trade. Maybe it might take like 3 days only, but I would not suggest doing that because you will have a lower win rate as well because you never know if price wants to come back and sweep you before creating that move, right? So it might take multiple tries before you get that real bottom of the move. That's why I recommend you guys to just, again, stick to essentially taking what the market gives you. Stick to your TPs, of course, and not getting scared of the market movement, but just making sure your TPs are at realistic points, understanding that we are entering off the 1 minute and we're not entering off like the 15-minute confirmation in terms of structure, right? So, again, that's basically the gist of today's video. I just wanted to go over and help you guys understand the fragile nature of the market. Hopefully, this video has helped you with your logical and understanding of how the market moves in terms of time frames. And again, picking out time frames, I already showed you guys what time frames I use. You guys feel free to copy and use that same ones I use. these are just ones I found from backtesting networks the best. So, yeah, thanks for watching, and I'll see y'all in the next one.